Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Hold the range. They threatened yesterday to get up above the old year-to-date high near 312. Got to 311. Today we sat just below it, up to and after the Fed. So the market seems to be creating some kind of a comfort area north of the 3% yield level that we had struggled so mightily to get through since the May top was put in. So right now we're kind of holding steady, extending that range, we'll call it. We used to say 280 to 3%. Now we may actually say 280 to 310, and that's going to be the market's new comfort zone. Has yet to be seen, but ultimately I think that the failure to bust through, even on a hawkish event like FOMC was supposed to be, suggests that the top may be in at least temporarily. So market is actually trading down a few basis points post-Fed in yield. So right now we're heading back towards that old range, but we'll call the new range what it is, and that's a comfort zone. If you look at market volatility, well, market volatility got crushed. Let's just call it what it is. We didn't see much of a buildup ahead of FOMC. We didn't see much of a buildup of angst as far as would the market trade outside the range. Probably the reason why we never saw a trade outside the range is no one expected it to. Market volatility gets hit pretty hard. We're going to go back down towards those levels we saw about 2 to 3 weeks ago, testing those year-to-date lows. Likely with the idea that while trade is still an issue, while there still continues to be some issues with the housing market, while there could be some issues in the credit markets moving forward, not here but elsewhere, the market seems very content. The U.S. economy seems to be doing well enough that it can stomach any kind of adversity. And the Treasury market is, again, stuck in that range. So market volatility on the lows, and FOMC. Yeah, they're going to continue to raise rates. This year, we're going to get a decent rate hike, at least according to Fed Fund futures. And yes, the Fed wants to raise rates 2 to 3 times, possibly 4 times in 2019. But I don't think the Treasury market's buying it right now. The market today will tell you that it doesn't see clarity that far ahead, while the Fed may see clarity that far ahead and expectations for 2.5 to 3% GDP in 2019. I think the bond market wants something more substantial, and it won't get there until at least after we get out of 2018, possibly until we see some growth numbers from 2018 in mid to late January. So I think that there's bond market's going to be a little bit more cautious. We saw the yield curve resume its flattening trend. Recall 2's got above 25, well back below it, probably on its way to 20, at least in the short term, as the 2-year note is roughly unchanged since the Fed, and the 10-year note continues to see yields decline. So right now, Treasury market stuck in a range. I don't anticipate we'll see any kind of surprises. In fact, I think we're going to trade back towards that 3% marker. Today's the 7th consecutive day we've traded above 3%. Got to go back to May, the last time we saw 7 consecutive days of that. If we go tomorrow as well, which it looks like we will have set a new year-to-date record. So right now, Treasury's holding above 3%, but I don't think that we're going to see much extension. This is Todd Colvin coming to you from the floor of the CME Group.